If you like what you see, if I can please request you to subscribe to my channel. So what is relative valuation? A relative valuation, also known as a comparables valuation, is an effective tool that involves using a similar comparable asset to value another asset. It is flexible and can be used in numerous industries like the pharmaceutical industry, or the fast-moving consumer goods industry, or even the automotive industry. These are just a few and not exhaustive. Essentially, we should define a multiple, describe it, analyze it, and finally apply it. Finding comparable companies is actually not an easy task and is in fact a lot more difficult in practice. So which are some of these multiples? There are earning multiples like price to earnings, or enterprise value to EBITDA, or enterprise value to cash flows. There are book value multiples like price to book value, or enterprise value to replacement cost ratio. There are revenue multiples like enterprise value to sales. And there can be industry-specific ratios, for example, like price to ton of steel. Well, there's so many multiples, where should I start? The price to earnings is simply the price of a share relative to its earnings. The price to earnings ratio is used by investors to determine the relative value and can be used to compare against a company's own historical record. Another way to think about this ratio is simply to look at the market capitalization and divide it by the net profit of the company. The P/E ratio holds the most value for investors when comparing against similar companies in the same industry. Another good metric to be familiar with is the enterprise value to EBITDA. You can simply take the company's enterprise value and divide it by the earnings before taxes, depreciation, and amortization. Both these metrics analyze a company from different perspectives. The EV to EBITDA considers the whole company's capital structure relative to cash earnings generated from the company's core operations. But in relative valuation, are there any limitations? Well, I can think of a couple. For one, you are trusting that the market has valued the asset correctly. Besides that, it is impossible to get a clear picture of the company without analyzing its intrinsic financials. They are backward-looking, which is not an indication of future performance. So what's the final word? Well, I think relative valuation is a good start. It's simple to understand. It does not require huge amounts of information. And so it does give us some early indication of a valuation of a business. So my question for the day is, what is intrinsic valuation?